Carl, thanks so much. Welcome. Halftime report. I'm Scott Wapner. Front and center this hour, the post-election stock surge. How long it might last, we will ask the investment committee. Joining me for the hour, Joe Terranova, Anastasia Amoroso, Jim Leventhal, and Rob Sechin. We'll take you to the markets. Guys are just saying, I mean, stocks at record highs. The small caps are leading today. The S&P's above 6,000. Tesla's up big again, up near 40% since Election Day. The dollar's the highest since August the 1st. The bond market, well, it's closed today for Veterans Day. So we're not really paying that much attention to yields, even though they've been a considerable story. Joe, Oppenheimer today, they bump up their S&P target for the end of the year once again. It is the third time they chase. They go to 6,200. UBS says the year-end rally has more room to run. Most of the notes last week suggested you've got a window of opportunity between Election Day and Inauguration Day at least. How do you see it?
I see it exactly that way. I think we are in the midst of a chase for performance. Jimmy, first of all, thank you for your service, and to all the veterans watching the show, thank you for your service, men and women.
Well said.
You're very kind, Joe.
And Jimmy, you've been on the chase for performance, and you've talked about the chase for performance. Congratulations for doing so. That's exactly what's going on right now. I also think that a lot of money managers have what I call position flexibility, because, Scott, you had that October flush. That October flush really shook a lot of people out of the equities market. So I see plenty of runway ahead as we move into the end of the year for this rally to continue. I think the rally is broadening significantly into high volatility, high beta areas of the market. We haven't seen that since 2021, and that doesn't mean on the other side of it you get a 2022 style market.
Anastasia, despite the fact that some say valuations are now stretched, positioning's crowded, and I don't know about full or not, how do we see things? Do you agree with those who suggest from Election Day at least to Inauguration Day, you've got an opportunity to basically watch your investments in almost any asset class you pick go up?
I do agree with that. I think you want to lean into the year-end rally. And look, there's this sense of exuberance in the market, but I think it is justified because we're focusing not only on the trade for the next couple of months, but also the regime for the next 2 years or maybe 4 years, depending on the makeup of Congress. And that regime is one of hopefully less regulation and also tax cuts extension. So that's what the market's so focused on. But also, Scott, to your point, there's the seasonals that you just don't want to get in front of. And you don't want to fight that. You don't want to fight the Fed. You don't want to fight the seasonals. And, you know, Joe is right. There has been some flushing out of positioning, and now the volatility is actually quite a bit lower. That allows people to get back into risk. That allows risk parity funds, for example, to bump up their equity exposure. So I think we do have this nice window of opportunity. But I will say that even though the long-term outlook, I think, is a positive one, if you think about what the first action is likely to be when President Trump takes office, it's not likely to be taxes. It's likely to be tariffs. So I do think you have to watch for those bumps along the way.
Lieutenant Leventhal.
Sir.
We are grateful for your service and to have you with us. 2 Navy Commendation Medals, 4 Navy Achievement Medals for the former nuclear submarine engineer in the United States Navy.
You're always very kind, Scott. Thank you. And I'll just tell you, it was a great privilege. A great privilege.
Well, we honor you every day, but certainly we single you out on this day. Especially.
Thank you.
Please, your view on the market.
So I'm going to say something that may sound surprising to everyone, but this has nothing to do with valuation. You're not going to hear me say the market's expensive, cheap, or otherwise because it's irrelevant. Joe, what you said is exactly right, and Anastasia, you added to it. This is a chase to performance. This is FOMO. This is all of those ephemeral things that have absolutely nothing to do with valuation. It may actually be, I'm going to paraphrase what you're saying, Scott, but in my words, throw a dart at a board. Having said all that, now, let me try to put some sobriety to this. If you're nervous about valuation, if you're saying, I don't really know, there are plenty of stocks that are trading with good dividend yields to give you cushion, fairly low multiples, whether it's of earnings or book value. So this doesn't mean you have to buy the, highest PE ratios and just close your eyes. But I just want to say it's not just the sentiment that we're talking about. When we turn the calendar year, there's going to be a powerful force of the drawdown of the Treasury's Treasury General account at the Federal Reserve, which will increase liquidity. I've got to give a hat tip at Dan Clifton at Strategas. He's the one who has been pounding the table on this. It's a proven pattern. that when we hit the debt ceiling and Treasury starts taking its money out of the Federal Reserve, paying people and companies and putting it into the commercial banking system, liquidity increases, interest rates go down, stocks go up.
Rob, I mean, you had turned a bit cautious, I think is fair. How do are you reassessing that? I mean, how does somebody who was cautious a week ago, and maybe for all the right reasons, now sort of resetting expectations on what some have suggested is this opportunity for a really good rally, certainly till Inauguration Day? What's your view?
You know, we are still tilting towards caution. The reality of it is, though, that hasn't manifested itself in positioning, because valuation, sentiment, and positioning are all stretched, as we all know on this show, but you need a catalyst to kind of cause that to unwind, and we haven't seen that. You need a weak payroll print. You need weak retail sales. You need anything that would cause people to question whether this sort of growth can continue. And you have to appreciate, like everybody else said, that we're in a strong seasonal period. You know, interesting stat that when markets are up 20% at this point in the year, 80% of their time they're positive in the final 2 months. We are not ignoring that, but we are not chasing performance. The reality is all this bring forward in performance increases risk in 2025. And when you look at the biggest risk from our lens, it's an earnings risk, because forward earnings guidance is getting cut, and yet prices continue to accelerate higher, which means this has all been based on valuation expansion, Scott. So we're here, but we're waiting to figure out when do we decelerate, and we're hoping that a lot of the gains we have this year can be pushed in to next year so we don't brutalize our clients from a tax standpoint.
All right, that's fine. I want to debate it, because as you're talking, Joe is sitting next to me shaking his head no.
No, Rob.
No. And he's making a
What
face
do you
with it
disagree
too.
with,
So
Joe?
let's put the words with the face that he was making. Why do you disagree?
We can't pretend that this doesn't come with some fundamental tailwinds in an existing secular bull market already. A very powerful force surrounding deregulation that's lifting some sectors that previously had been dormant in the market, like industrials, like financials. Corporate tax rates steady here at 21%. Does it go lower? Possibly, but at least you have the comfort that it's at 21%.
It ain't going higher, I'll tell you that.
Not going higher. Again, supportive of a lot of areas of the market, like financials, that have been dormant in the past. So I think that overall environment, you know, we like to use the words animal spirits. I know Mike Santoli has rightfully pointed out they've already existed in this market. I agree with that, but I think you see the increase in corporate activity. You see a lot of M&A. You're going to see a lot of R&D out there, and I think that sets us up for what should be a positive year. Maybe not to the pace at which we're moving right now. I'll agree with you on that, Rob, but I don't think we want to turn the page into 25 and expect a negative year for the market.
Rob?
Yeah, I would say that you're right on deregulation. You're right on a less restrictive stance towards M&A. You're right on corporate taxes, but that's going to take some time to get initiated. Tariffs could happen quickly and potentially be disruptive. Immigration could happen quickly, which could also disrupt the labor supply. So I think you have to stay disciplined, Joe. Quality, dividend-paying names, valuation discipline across the capitalization spectrum makes a ton of sense. And let's remember the lessons from 2016. The initial reaction to Trump's election was very positive. Very positive. You had jumps in value stocks, cyclicals, small caps. It lasted about 2 months, Joe. And the moves all faded as soon as 17 began, and leadership was very different. So, listen, we're counting on the other 493, not the Mag 7, to deliver significant earnings growth next year. The probability of that has no doubt increased with the change in the White House.
Okay.
Agree with you.
Okay, is there too much euphoria over this point of view and perspective that now it's just, hold on, now it's just like run away?
Look, I mean, some of it is euphoria and sentiment, but some of it is fundamentals. Even if we didn't have this election, if I look at the earnings outlook for 2026, $303 is expected in earnings. And at some point, the markets are going to start caring about that number. And by the way, earnings revisions may have been negative if we didn't have the red sweep outcome that we have, because we might have had the potential for a corporate tax increase. Now that's taken off the table. And so that's why we actually may have more certainty in that fundamental earnings outlook. But I will say I'm sympathetic with Rob that I think the first order of business for this Trump administration is going to be tariffs. It's going to be immigration, it's going to be tariffs. And that's why if you're not already positioning, you should be for rotation back into the domestically oriented stocks.
See, the thing is, if you yes, if you focus on the tariffs and the immigration issues, which may dominate the earliest days, to what degree should you price in the re-upping of the tax cuts? So across the board, and then stimulating growth more through the deregulation and the other things that may come down. It's like you don't want to get too negative on the negatives, because the positives have a chance to fully outweigh those.
So
is that a okay view?
Spot on. And I'll say this. In terms of the tariffs, pull up the semiconductors. Besides NVIDIA, look at the semiconductor equipment names, whether it's Lam, KLA Corp, Applied Materials. They've priced in the potential negative effect. Probably not fully.
Have they?
But they've begun to price in. They have begun to price in the effect of the tariffs. And by the way, I got to respond to Rob. Rob, I'll take 2017 any day. It was one of the lowest volatility years. The VIX never got above 20. The VIX traded to 8, and we had a 17+% return on the S&P. 17 in totality was a great year.
You also started from an entirely different base, Joe. Interest rates were 1.8%. I mean,
Rob, no one knows how high is high.
What does
Just
that
because
mean?
the S&P has a 6,000 reading on it doesn't mean that's the peak.
But are you saying that 22 times forward P doesn't matter? You're making me sound like a bear. I'm not. I'm fully invested. It's actually quite comical. But the reality of it is if you're not paying attention to the risk, you're whistling through the graveyard, buddy. There are risks brewing out there. There is no question, and those risks manifest themselves in price, sentiment, and positioning. And if you're not paying attention to at least one of those and protecting yourself from a valuation standpoint, you're ignoring one of the central tenets in investing. I'm sorry.
There's a couple of things. First off, I'm not going to slam Rob for being, the voice of reason, but there's a couple of things that are wildly different than 8 years ago. Number one, the Fed's cutting rates. It was the exact opposite in 2016. There was nowhere for them to cut. They wanted to go higher. Number two, we were at the end of the 2015 currency devaluation in China. Now we've got China stimulating. That's a big difference. Now, I know, Rob, you may be thinking like the Aesop's fable, the grasshopper and the ant, and today I'm the grasshopper and you're the ant. Maybe that's a little reversal of characters for us. I'll take that. I'll take that insult to myself, but I'll tell you, I think we got at least 4 or 5 more months before before the chicken comes home to roost.
Okay, then the question is, if you think you have that runway, where do you want to lean into? The top sector ideas, according to Oppenheimer today: financials, industrials, and technology. Financials just had their best week in a year. Names like Goldman up 17%, a record high today. Morgan Stanley, a record high today. B of A and JPM, 52-week highs today. Jimmy, Citi's was up 12% last week. JPM
It
up
makes sense.
9.5% last week.
It makes sense, at least to me. For one thing, you're going to have lighter regulation, i.e. lower costs. How many times have we heard Jamie Dimon talk about the compliance costs measured in billions of dollars that his company faces? You're likely to have lower capital requirements. You're also likely to have one heck of a booming economy. Now, we may have to deal with inflation in a few months, but what you're going to see in the immediate offing is deal making, IPOs, credit quality going up. I mean, there's a lot of reasons to be bullish on financials here. And by the way, the valuations are pretty good.
Yeah, Wells Fargo today, target goes to 84 from 75. B of A reiterates their buy rating. They call it the best risk reward. Rob, you own Wells.
Yeah, and I would say we like the financial sector. We're overweighted. They're ultimate beneficiaries of a soft landing and a steeper yield curve, which drive their net interest income higher, Scott. But, we're focused on the less fully valued names right now at the margin, like Jeffries and Comerica. Wells has done a great job at managing expenses, relative to some of their peers. But again, if you can go down capitalization, I think there's more bang for your buck.
Well, Joe, I mean, maybe this finally is the moment for the regionals. Russell obviously is loaded with them, and the Russell's been the outperformer. And you got a ton of these things.
Yes.
Cincinnati Financial, Fifth Third, Huntington Bank shares, Hartford Financials. What do you think?
I think the strategy did a wonderful job over the last several quarters, putting the positions in the right place. Coming into the election, 28% exposure towards financials, asset managers, private equity, insurance companies, and yes, regional banks. And as the positions were building in regional banks, I was skeptical myself, looking at how the rules were being affected. But now, obviously, with 28% exposure, it's benefiting us dramatically. You can see what we're doing over the last 5 days, and I think it's the right place to be in terms of the opportunity, the most powerful catalysts fundamentally that are going to come from this new administration affecting this sector.
Private equity, since you mentioned it, over 1 week, Apollo up 19.5%, best week since October of 21, did hit a new high. You had a positive call on that today. You did sell KKR recently, but Ares, Blackstone, Carlyle, the ones we're talking about. Anastasia, your view of this group, if you and include private equity and the tailwinds that many see now behind that business, which has been sitting on a lot of dry powder, and B, looking for a lot of realizations, and they may have their opportunity in a less onerous regulatory environment.
I think it's the sector to look at, and there's this renewed sense of optimism when it comes to private equity in particular, because you're right, there's not been a whole lot of exits, there's not been a whole lot of deal flow, but that is turning around even before we had this election. So for example, when you look at deal activity across all the different strategies, we're on pace to about $2 trillion of deal volumes this year, which would exceed 2021. And if you look at the exit activity, Jim, you mentioned IPOs and M&A activity, it has actually picked up, and actually exits through the third quarter of this year are already pacing the full 2022 and 2023 volumes, and that's again before the election. So as we have this backdrop of less deregulation, regulation, I should say, and as we have the holding period that's been quite extended for these private equity companies, I think it is going to be a perfect environment for more capital market activity. So that's why we're seeing some of these stocks trade at all-time highs, and I think further upside is to be had.
Rob, what about industrials? Best week since October of 22. You got a few names in the group that have done quite well.
Yes, we own a lot, but we're kind of underweight the sector. I mean, you're probably talking about 3M, which has been a real winner for us. But these companies are extraordinarily expensive. They're trading at a 24 times forward P, which is actually a premium to the S&P 500. And the challenge is that they're very cyclical business, and usually these higher values mean that forward returns get trimmed, makes us very selective in what we own. And using 3M as an example, that was really a turnaround story, which led us to initiate that position. I do think names like, yep.
What if what's going to occur, what might occur, I mean, we'll just have to see. Nobody really knows, but that you have the potential of, I've heard some estimates that, you could double the earnings power of this market, which would then allow the multiple to expand because you'd be justifying it with strong economic growth. Therefore, what today looks expensive might not exactly look that way tomorrow, so to speak.
It was a big debate on the investment committee this morning at the firm, Scott. I think no doubt this administration does lead the probabilities of earnings delivery and maybe revising forward earnings estimates northward up. So those probabilities have changed. Have they changed dramatically enough to lift stocks in line with where expectations are? That story's yet to be written. All of us that are fully invested certainly hope so. And, those probabilities are higher. So I think at the margin, if it were absent price and I still think you have to pay attention to price, that you could see some really good earnings delivery next year because of the ambitions of the administration. I caution that some of this takes a while to manifest itself.
Sure, but you get ahead of that. That's the whole point, right? That's how the market tends to work. You guys are in it every day. You know it far better than me. But that's how things work, right? We start to anticipate what's likely to happen. You think that the market's gone up from election day to now on anything that's happened? No, it's on anticipation of what's likely, if not probable, to happen. Let me get Joe back on industrials, because you got a ton of names here. Your exposure is 22.5%, so big. Axon Enterprises up 42% in a week. United Rentals up 14%. Eaton 12%. Granger up 11.5%. All of those that I just read are at record highs.
Airlines as well. We added United Airlines and Delta. They're up double digits as well. I don't have the degree of optimism and confidence that you'll see such a fundamental tailwind effect from the new administration on industrials themselves. Yes, we're carrying a 22% exposure. A lot of that is driven off of momentum from President Biden's administration and the Inflation Reduction Act and the effect of that as well. So I don't feel the same about industrials that I do about financials. I feel much better about financials. And, I'm listening to Rob, and I always pay attention to price. Price is probably the most important thing that I'm looking at. I think Rob and I are basically saying the same thing. Rob's fully invested. He likes the good environment. But I think Rob tactically sees that we're ripe on the other side of the calendar for a potential correction. And I wouldn't disagree with that at all. But on the other side of it, I'd buy it.
Well, I mean, are we ripe for a correction in some of the things that have ripped a lot, like crypto? I don't know. Coinbase is up yet again, nearly 20%. Bitcoin's 85,000. It's been pretty remarkable. Mackenzie Sigalos is here with us at Post 9. I mean, we know... I think we know, have a sense why, but you have more detail on really why. Like what the expectations are that the market is betting is a game changer for crypto investing in general.
Yeah, so Scott, so much of this record surge in the crypto market comes down to 4 promises that Trump made to the industry. On day one, he says he'll fire SEC Chair Gary Gensler. That's very likely why you're seeing stocks embroiled in lawsuits with the regulators surging. Coinbase up around 20% today after ending last week 50% higher. Second thing here, the repeal of SAB 121, which is this niche accounting rule from the SEC that actually stands in the way of banks custodying cryptocurrencies like Bitcoin. Trump also wants to launch a national crypto stockpile and take $16 billion worth of Bitcoin that the government already holds and permanently take it out of supply. And finally, I've talked to several Bitcoin miners, the CEOs from these companies. They are having closed-door meetings with Trump. They say that he's promising heavy investment in the rapid build-out of energy production and transmission infrastructure across the country. These mining stocks seeing double-digit percentage gains.
I mean, the point here is people really think this is just the beginning of, I don't necessarily think that a renaissance is the right way to look at it, but a much more open environment, a much more widely accepted and adoptable environment, that this could be the first stages of some of those really crazy bullish calls that we've heard from years past that just couldn't materialize for a number of the reasons that, you've suggested may go away.
No, exactly. And it really comes down to SAB 121 and then another piece of legislation called FIT 21. You've got more than 280 pro-crypto lawmakers who comprise the incoming congressional session. And if you pass FIT 21, this is a crypto market infrastructure bill in tandem with rolling back this rule from the SEC that says that banks have to treat Bitcoin as a liability on their balance sheet. Suddenly the door is open to all of this cash from institutions.
Joe, I mean, you got Coinbase. You sit here, watch it. Just come off the best week since, January of 23.
Added it at the end of October. It's up 83% since then. The reasoning behind adding it has nothing to do with some wonderful insight into the fundamentals of what was going to occur. It was on momentum that was building. I will say Coinbase, the balance sheet has had dramatic improvement. They've done a great job of doing that. I also think the overall environment and the effect of crypto since President Trump's election is, to a certain extent, it's validated it as a traditional asset class now. And that's something that the industry for years had been looking for. Now I think that's what's occurred. I still think there's people out there that's questioning the fundamental usage. They're questioning if it's going to be, you're going to have transactional transactions on an individual and a corporate basis or not. But I think it has validated that as a traditional asset.
Yeah, well, I mean, the market's certainly betting on that. Look at, there's Coinbase, up another 20%. Mackenzie, thank you. That's Mackenzie Sagalis here, Post 9 for us. Coming up, we have a committee move to tell you about. Jim is buying the pullback in a stock. It's under pressure today. We'll tell you what it is next. All right, welcome back. We do have a move to tell you about. It is in the pharma space today, and it's for a stock that's getting hit. AbbVie is down today after its experimental schizophrenia drug failed phase 2. Jim Leventhal bought more of that. Why did you take advantage of this pullback to add to your position?
So obviously this is not good news. It is not expected either, but this is what happens when you're in pharmaceutical development. Not every candidate that you put forth is going to work. Now, this particular drug was going to be about $1.1 billion in sales 4 years from now. That's on a total revenue base for AbbVie of about $75 billion. So you can see it's not even quite 2% of what revenues might have been 4 years out, which is simply a way of putting there's a heck of a lot going on at AbbVie that while this is not good news today, the price decline is simply too great for the contribution that this drug otherwise would have made. I'm buying it in my personal account, and the reason for that is that for clients, generally they have enough of it. I'm willing to get much larger in the position in my own personal account. If it goes down further, I might possibly add more to it in client accounts, but I just think it's a simple case of too much to the downside. It trades at about 14 times next year's earnings, 3.9% dividend yield. I think it's just a great company on sale here. Last thing I want to say about this, Scott, is some people may say, well, they just bought this company that was producing this drug a couple of years ago, and they bought it for $8.7 billion. So does management know what they're doing? Yes, management knows what they're doing. As I said, sometimes in this business, things go wrong. They have a long track record of making excellent acquisitions.
All right. I'm out of town this weekend. Some dude comes up to me and he starts talking about app loving. And I was thinking about you, because you're the guy, Joe, who on our show who owns that stock. It's going to join the NASDAQ 100, replacing Dollar Tree, November 18th of this year. It's up 600% year to date. No wonder why it was the topic of conversation, but it was the one stock that was mentioned in the encounter that I had. App loving, stock of the year.
The topic of conversation in many different places right now. Full candor. When we first added this name to the strategy, I looked at it and I was kind of like, what does this company do? That's being completely candid. What exactly do? So for the viewers, what do they do? Okay, they are in the ad tech business. They are in marketing. So if you're a mobile app developer, you need them. They have 1.4 billion users. They have an AI advertising engine. And what it's doing is it's affecting growth rates for this company that are staggering. The company is in the sweet spot with all the mobile app developers, whether it's gaming, you name it. And with this $1.4 billion user base, okay, this company is going to be around for years to come. Now, you see the stock right now, $280. It's down 3% today. It's being added to the NASDAQ 100. Does it ultimately get to some of the price targets that I see near $400? I believe over the coming years it does. But understand, if you're buying this stock, it's highly volatile. This is going to be a volatile stock over the coming quarters. You have to keep that in mind. So make sure you size the position accordingly. Right. You got to take a small position here.
CRH target goes to 104 from 95. Morgan Stanley. That references 2025 earnings and the recent re-rating of listed peers across the U.S. and European markets. Jimmy, you own that one.
I mean, this is a pretty cyclical company, right? This is aggregates, this is materials for all types of construction, whether it's homes, whether it's non-residential capex. Look, we know that the housing market has been in recession for quite some time, but lower interest rates on the way should help that, should help construction. And in the meantime, all that infrastructure spending and supply chain onshoring, this is a direct beneficiary of it. It has good results in its recent past, and I expect them to continue.
We're debating a lot of retailers these days just because if you talk about, Joe, tariffs, you just don't know what the the cost to buying power is going to be for consumers. That's the National Retail Federation talking about that, not me. Ross Stores cut today 164. That was at 172. They still like it at Morgan Stanley, but they lower their estimates based on a weaker sales outlook. What do you think?
I think everyone likes Ross Stores because they do a great job with the balance sheet, off price itself, very similar to TJX, but it had a very strong rally during the summer when we believed that the economy was cooling. Now on the other side of that, we've got an indication that maybe the economy is not cooling as much as we anticipated. And to your point, you're introducing the possibility of tariffs. So a lot of these off-price names are beginning to struggle. Ross Store is one of them. TJX, by the way, is an outperformer in off-price. So I would own that one more than I would own some of the others. Ross Store has what I would call right now broken momentum.
Okay, Adobe, Rob, reiterated overweight at Barclays today. They have positive takeaways, they say, from management meetings. They don't think growth accelerates and don't think the stock needs acceleration to work at the valuation it's currently trading. What do you think about that, Rob?
Definitely has been a tough performer. It's a name you have to be patient with, but we ultimately view this as a double-digit compounder with healthy fundamentals, Scott. They're seeing slower progress on the monetization of their AI with the Firefly platform. It's a show-me story, given the competitive pressures from OpenAI and others. So, listen, we own it. We're down on it this year, but I do think it's something you can own at these levels for sure.
All right. Get that. Time for the setup now. Earnings this week on holding. That's tomorrow before the bell. 52-week high today. Jim Lebenthal, you own that.
Definitely a pricey stock. That's where I always start because it's a little bit outside of my comfort zone in terms of valuation. However, it's growing like a weed. People love the shoes, love the apparel. They're growing in their geographies. They're growing in the number of SKUs that they're putting out there. I think this is going to be an excellent holding for the next year.
Rob Seach, Home Depot. That's tomorrow before the bell.
Yeah, I think we're looking for is the worst behind us from a home improvement spending standpoint, and will lower rates or the prospect of lower rates in the future start to encourage investors to invest in Home Depot due to this. I also think you're going to see a slight uptick in sales trends as extreme weather has led to some incremental consumer spending.
Are we, Anastasia, what's your view on housing? I mean, if we're going to be in an environment, potentially of higher rates for a while now, and in part because of the agenda that's coming with the new administration, you have mortgage rates going to be probably more elevated. I think right now they're right up against 7% again.
Yeah.
What's the impact on the housing space?
That's right. I don't think the recovery in housing is a done deal because of exactly what we just mentioned. I do think that the 10 years probably stuck at a broad range somewhere between 4% or 4.3% because we got budget deficits to worry about, we got stronger growth and less rate cuts to worry about. So we may be working with elevated mortgage rates for quite some time. The good news, though, for housing is a lot of consumers have built up a lot of home equity in their homes, so they might be able to leverage that to help a stock like Home Depot. But I do want to point out broadly, if you look at XLY, for example, the consumer discretionary ETF is doing great, and I think that's the broad trend.
Okay, Spotify, Joe, after the bell tomorrow, it's a record high today.
This one has a very high bar to exceed. It's at an all-time high, very rich valuation. It's delivered 19% revenue growth the last 2 quarters. You need to see revenue growth in the 20s. Free cash flow is building as well. Again, you need to see that accelerate.
Farmer Jim, Disney, Thursday before the bell.
Yeah, and actually a little bit of a bid to Disney the last few weeks now. We know it's had a pretty rough year. It got up to 123. Now it's back to 100. I think on a valuation basis, the stock is definitely a hold. You can probably add to it here. I mean, things that you're looking for in this earnings release are, how's the streaming business going? Theme parks, which were a problem earlier, earlier in the year, that is, are they recovering? There's a lot of things that can go right here, and I don't think are priced into the stock.
All right, Mike, say. Let's do some finals. Robert Seachin, you're up first.
CRMs. Sorry, Scott. Background noise. CRM.
Okay. CRM. It was so nice we said it twice. No explanation needed, apparently. Right? I was waiting for that, but it's all good. Farmer Jim.
Lockheed Martin. As much as I hate to say this, the world is still going to be a violent place. I know our incoming president has the noble goals of curtailing a lot of military activity overseas. I'm not sure it's really in his power.
Okay, Anastasia.
Small caps. It's been hard to have conviction in small caps until now, but if you look at where they are, it's been a 3-year range, but I think we're breaking out of that. Domestic orientations, focus on financials, focus on rate relief. It's not too late to add to small caps.
You agree with that? You like that call? So if you're going to get a broadening in the market, I mean, this might finally be the moment. It's up 9% in a month.
I agree with it.
Okay.
Not gonna
Jimmy,
come to
Well, you don't have to. What do you mean?
You're not going to come to me on that, really?
What's your quick?
I agree with it. I've been pounding the table for months.
Okay, great, thanks.
Best performing financial stock is Interactive Brokers for us.
Okay.
The ETF, I think it continues. The trading environment's phenomenal.
All righty, I'll see you on the closing bell. The exchange begins right now.